I want to introduce briefly the concept of economic policy. And economic policy is a fairly complicated area, but it can be split into three main areas. Fiscal policy, which refers to the government's budget, in other words, its fiscal stance, and its spending and its revenues, which are in the form of taxes. So that's fiscal policy. It encompasses a second area, which is monetary policy, which refers to setting interest rates and buying and selling bonds in the market in order to influence the amount of money that's available in the economy. And it also encompasses trade policy, the setting of tariffs and trade barriers for certain products and goods. Now, economic policy is different in each country, but these three elements are core elements that can be found in almost any open Western economy. And the economic policy is set generally by the governments and the central banks, in particular with the central bank setting the monetary policy and the interest rate policy, in order to achieve steady growth while at the same time keeping inflation in check. So economic policy in general refers to three broad areas. The first being fiscal policy, which refers to government spending and revenues and managing the budget. Secondly, the monetary policy, which refers to the setting of short-term interest rates and effectively taking money out of the economy or putting money into the economy in order to keep inflation in check. And trade policy. Now, in most Western economies, the monetary policy is increasingly set independently of the government by a central bank, or in the US, the Federal Reserve Bank, whose primary goals are to keep the inflation rate in check. But clearly, the fiscal policy and the monetary policy, and even to some extent trade policy, have to be coordinated, or at least the other elements borne in mind. Because if, for example, monetary policy is targeted at keeping inflation in check, then potentially fiscal policy also can play a role by reducing the amount of spending in certain areas that may be causing inflation. But the monetary policy's targets in the US and the UK primarily are inflation. They're different in other nations. They may relate to the currency. They might relate more to growth than to inflation and stimulating growth. Fiscal policy, on the other hand, refers to a government's budget and to its spending and its revenues. In other words, how much it's spending in certain areas of the economy to stimulate the economy on public projects, highways, education programs, schooling, general public spending, and also to its revenues, i.e. the revenues it takes in through taxes, where the tax policy is set higher, set lower, and where taxes are applied in order to potentially slow down or speed up different parts of the economy, or incentivize or disincentivize certain behaviors, for example by taxing alcohol and cigarettes, or for example by offering tax breaks to small business startups in order to stimulate growth in the small business segment of the economy.